The real estate market has been on a wild ride, but the thrill might soon turn to dread. Did you know that over 14% of US homeowners are considered equity rich, meaning they owe less on their mortgages than their homes are worth? It sounds great, but what if the market turns? If prices drop, many could find themselves underwater, owing more than their homes are worth. Here's another eye-opener. Since 2020, home prices have surged by over 40%, but wages haven't kept up. As of 2023, the average home price in the US is around $400,000, while the median household income is only about $70,000. This gap is widening, and it's not sustainable. When people can't afford to buy, the market may start to crumble. In this video, we'll explore the signs of an impending collapse that many are ignoring. We'll dive deep into strategies for savvy investors looking to navigate this shifting landscape. You'll learn about the dangers of high leverage, the risks of short-term rentals, and why property values might not rise as they used to. Get ready to uncover the truth behind the current market and find out how to protect your investments as we face this potential downturn. The clock is ticking, and the time to prepare is now. Chapter 1. Bubble, meet needle. Signs of a ticking time bomb. If you take a closer look, cracks are everywhere. Most people know about high prices, but there's much more at play. For example, the US homeownership rate has been hovering around 65%, a level not seen since before the 2008 crisis. This stat looks okay, but dig deeper, and you'll see that much of the demand isn't from individual buyers. Hedge funds, institutional investors, and short-term rental companies have snapped up properties at record rates. One red flag? Institutional investors accounted for 18% of all single-family home purchases in the first quarter of 2022. That's nearly 1 in 5 homes bought by big players, not families. These investors have bet on continual price increases, but they're not buying to live there, they're buying to make a profit. That profit depends on rents rising, which isn't guaranteed if incomes can't keep up. Another often overlooked factor is the rate of zoning approvals for new high-density housing. In many cities, zoning boards have rushed to approve high-rise condos and apartments, lured by the promise of tax revenue. It's like the housing boom of 2006 all over again, but with luxury rentals instead of suburban mansions. Once these new units flood the market, there may be more supply than demand, putting pressure on prices to fall. Even Warren Buffett, a legendary investor known for his long-term view, has pointed out that price is what you pay, value is what you get. The problem today? Many properties are priced far beyond their true value. The market is riding on hype, not fundamentals, which should worry any value investor. Chapter 2. The smart money exodus, where savvy investors are fleeing. If you want to know what's really going on in the market, look at where the smart money is moving. In recent months, we've seen notable investors quietly reducing their exposure to real estate. Big real estate funds have shifted away from residential assets, especially in overheated markets like Los Angeles, San Francisco, and New York. For instance, the Blackstone Group recently sold off a portion of its US office buildings, despite still holding billions in real estate. Some experts believe they're trying to hedge against what could be a rough period ahead. These are not panic sales, but they do signal caution from firms that have typically made huge bets on real estate. And it's not just real estate funds. Some of the world's wealthiest individuals, like Jeff Bezos and Elon Musk, have reportedly sold real estate assets in recent years, cashing in on high prices while they last. If you want a real clue about a downturn, track the behavior of these ultra-wealthy individuals. They have access to the best data and advisors, so they tend to move before the general market catches on. One reason for this shift is that many of these investors see better opportunities elsewhere. Value investing is about finding assets that are underpriced, with the potential to grow over time. In the current market, traditional real estate doesn't fit that bill. Instead, smart money is moving into assets like infrastructure, technology, and even commodities. These sectors may offer more stability and growth potential as real estate cools. Chapter 3. Rental empire in ruins. Cracks in the Airbnb cash machine. Short-term rentals have been a goldmine in recent years. Platforms like Airbnb and Vrbo turned ordinary homeowners into property moguls, buying up multiple properties and converting them into vacation rentals. But here's the problem. In many places, there are now more Airbnb listings than there is demand. In 2023, more than 60% of vacation rentals in popular markets like Arizona and Florida were left vacant during off-peak seasons. That's a stark warning sign. During the COVID-19 pandemic, everyone wanted to escape to a private rental. Demand skyrocketed, but as the world has opened up, demand has normalized. And in a city like Austin, Texas, where Airbnb listings have increased by over 150% since 2019, there's suddenly too much supply. In some cases, owners are slashing nightly rates just to cover their mortgage payments. One key lesson from this trend is that the Airbnb bubble may be similar to the subprime mortgage crisis of 2008. Back then, buyers over-leveraged themselves on properties, expecting prices to rise indefinitely. Today's Airbnb owners are doing something similar, assuming that their high-income model will last forever. But if nightly rates fall or vacancies rise, these properties quickly become liabilities, not assets. In addition, many cities are tightening regulations on short-term rentals. In New York City, new regulations require Airbnb hosts to live in the property they rent out if it's in a multi-family building, aiming to reduce the number of short-term listings. With these rules and others, cities are attempting to control the short-term rental boom to avoid displacing long-term residents. This is bad news for investors banking on continued high rental income. As Ray Dalio once said, "He who lives by the crystal ball will eat shattered glass." For many Airbnb investors, this quote could soon become painfully true. Rather than continuing to chase short-term rental profits, it may be wiser to reconsider other investment options or focus on long-term rentals that cater to steady demand from locals rather than tourists. If you're finding this information valuable, don't forget to hit that subscribe button. Stay updated with the latest insights and strategies to navigate the changing real estate landscape. Chapter 4. The Debt Trap, Mortgages, Leverage, and the False Security of Equity. The real estate world has a dirty little secret: debt is everywhere. Mortgages are the backbone of the market, but with rising interest rates, this dependency on debt can quickly turn dangerous. In recent years, buyers have been taking on bigger loans than ever. As of 2022, the average mortgage debt in the US topped $250,000, a record high. And many of these loans were issued at rock-bottom rates, meaning owners could pay them off, as long as rates stayed low. But now, rates are rising fast. When those low-interest loans reset, monthly payments can double or even triple, putting huge pressure on homeowners. Many people believe they're safe because they have equity in their homes. But here's the problem: equity isn't cash. It's just a number on paper until you sell or refinance. If prices drop, so does that equity, and your home could become worth less than your mortgage. Another danger is in adjustable rate mortgages, ARMs, which have made a surprising comeback. In 2021, ARMs made up 10% of new mortgages, the highest level since the financial crisis. When interest rates reset, these loans become much more expensive. Many buyers will struggle to meet payments, which could lead to a wave of forced sales and foreclosures. And then there's investor leverage. Many real estate investors borrowed heavily, expecting rental income to cover their debt. But if tenants can't pay, or if vacancies rise, these leveraged properties turn into liabilities. Benjamin Graham, often called the father of value investing, warned against high leverage. He believed that the investor's chief problem, and even his worst enemy, is likely to be himself. In this case, the greed that pushed investors to take on more debt could end up being their downfall. Chapter 5. Building on sand, the myth of ever-rising property values. For years, the common wisdom was that real estate values always go up. But history shows us this isn't true. The housing market has crashed before, and it can happen again. Between 2006 and 2012, home prices in the US dropped by more than 30% on average, wiping out trillions of dollars in wealth. So, why do people still believe property values will always rise? Part of the reason is psychology. People like to think that tangible assets like houses are safer than stocks or bonds. But just because you can touch a house doesn't make it immune to market forces. Houses, like any asset, are worth what people are willing to pay for them. And right now, with affordability at an all-time low, fewer people can afford to buy. According to the Federal Reserve, housing affordability is the lowest it's been in 30 years. This means that the pool of potential buyers is shrinking, which will put downward pressure on prices. Plus, inflation is making everything more expensive, which affects people's ability to save for a down payment or qualify for a mortgage. Another factor is population growth, or rather, the lack of it. In the 1970s, the US population grew by 11%, creating demand for new housing. Today, that growth rate has slowed to under 5%. With fewer new families forming, there's less need for more housing. This could mean that property values might not grow at the same rate they did in the past, and in some areas, they might even decline. Warren Buffett once said, "Only when the tide goes out do you discover who's been swimming naked." When property values stagnate or fall, over-leveraged investors will feel the pain. For value investors, the smart move is to focus on properties that offer true value, those priced based on actual income potential, not speculative growth. If you enjoyed this video and want to learn more about navigating the real estate market, don't forget to subscribe. Stay tuned for more insights and tips that can help you thrive in any market condition.